TRU down a further 10.45%. This is Thursday, the 2nd of October, 2025. Intraday low, $70.20. Yeah, the stock's underlying trend is a bearish one. It has been printing lower prices relentlessly since it got this rejection at $92.53 on Thursday, the 18th. The following day, Friday night, the 19th, has just been in a downward spiral. Not that I was doing any better before then, so lower prices are expected to keep printing up till Monday the 13th, and after that, it may consolidate going all the way towards Friday the 17th of October. Then there might be a brief bounce, but ultimately still lower prices, at least by Thursday the 6th of November. These extrapolations are for prices way ahead in the future. The guarantee that they will happen is not very high. Margin of error, very, very high, very high. If anything, expect that maybe by tomorrow, the 3rd of October, that maybe we may still it may still print lower prices. You know, if anything, but extrapolating all the way towards the extrapolation that goes all the way towards the 6th of November, you really can't rely on that, and anything can happen between now and then. So projections are currently saying 82.76. Regardless, the algos are optimistic. Yeah, they're optimistic. Expecting that still rejecting, still reiterating an upper projection of 82.76. We printed an intraday high on this week as well. As a matter of fact, on Monday the 29th, it printed 94.37. That was probably a beat to, buy. Maybe there was some aggression there, Yeah, it has to be that. Okay, before then, so far, yes, Tuesday the 30th, they had additional upper projections, 80, 82, 84.61, yeah. And as of Tuesday the 23rd of September, projections were even more ambitious then: 90.71, 93.09, 94.55. Was this a retest? Yeah, okay. This was most certainly a test of those projections then. Price pressure momentums are severely bearish. Everything's severely bearish. Positions opened exactly 10 days ago, 21 days ago, 40 days ago. Well, you could just say positions opened all the way towards 200 days ago are not doing very well right now. Yeah, I don't think they're doing well right now. Well, surely, positions opened over the last 20 days, surely not doing very well. Yeah, yeah, they're not doing well at all. Okay, let's see now. Let's validate the price pressure momentums on the other moving averages. Let's have a look at the 40 period moving average. Let's see. Yeah, it's very bearish as well. Let's have a look at the 200 period moving average, 200 day moving average. Okay, let's see down here. Yeah, okay, as well, severely bearish as well. Yeah, that's what's going on right now. Okay, okay. So yeah, let's see now. We have some pieces of information concerning the stock.
TransUnion shares are trending down as investors react to news that Fair Isaac Corp will begin licensing its credit scores directly to mortgage resellers. This strategic move from FICO raises fears that major credit bureaus, including Experian, Equifax, and TransUnion, could face margin compression as their intermediary role in the U.S. mortgage ecosystem comes under pressure. Shares of all three credit bureaus tumbled Thursday morning, reflecting market concern that FICO's decision may disrupt a long standing industry structure. For TransUnion, which has historically benefited from high operating leverage due to its fixed cost, data intensive model, the potential erosion of pricing power is a significant headwind. That said, TransUnion has been actively working to diversify its revenue base. While its core business remains credit reporting for U.S. lenders, this segment has reached maturity. To offset slowing growth, the company has successfully expanded into adjacent verticals such as insurance underwriting, tenant screening, collections, and risk management solutions across multiple sectors. These emerging verticals accounted for 29% of revenue in 2024, up from 21% in 2009, providing a more diversified and somewhat less cyclical stream of income. This diversification could help cushion the company in the event of margin pressure in the U.S. mortgage channel. International expansion is another strategic pillar. The company has replicated its U.S. playbook across global markets, with India standing out as its most promising long term opportunity. Thanks to its early entry, TransUnion has established a dominant market share in the country's fast growing credit reporting ecosystem. While it may take years before India's credit infrastructure reaches full maturity, the demographic tailwinds and financial inclusion push provide a compelling growth runway. From a competitive perspective, the barriers to entry in the credit bureau industry remain exceptionally high. Building a database of millions of consumers requires decades of historical records and cooperation from thousands of financial institutions, an undertaking nearly impossible for new entrants, particularly amidst heightened scrutiny around data privacy and cybersecurity. This structural moat means that while FICO's move introduces incremental risk, TransUnion and its peers are unlikely to face displacement from new startups. In the near term, however, the market is focused on the potential revenue and margin squeeze from FICO's licensing strategy. Investors are questioning whether TransUnion's growth in verticals and international markets will be enough to offset pressures in its legacy U.S. credit reporting business. Bottom line, TransUnion remains a structurally strong business with high barriers to entry, diversified growth avenues, and a long term international opportunity set, particularly in India. However, the latest development with FICO has introduced uncertainty around the stability of its U.S. margins, keeping short term sentiment negative.
Okay, thank you very much for watching this video.